In financial markets, certain patterns seem to promise safety. But what if that promise isn't just wrong, but a lie? What if the path that looks safest is in fact a carefully constructed trap?
You know, traders all over the world learn the same thing. Find a reliable price level, place your trade, and then protect yourself with a stop loss. It's a strategy that seems so logical, right? And yet, it fails, repeatedly. So the real question is, why?
Well, the answer lies in a pretty tough truth. Those obvious patterns, the ones you read about in textbooks, they aren't safe zones. They're actually targets. And the very thing that makes them seem reliable, their predictability, is exactly what makes them so vulnerable.
This is TRADEVERSE, and our job is to unpack the hidden dynamics of global markets. In this explainer, we are going to dissect a very deliberate, very common phenomenon, something called the liquidity trap.
So to really get how this trap works, we first have to understand how it's set. And it all starts with a concept that's, well, it's familiar to pretty much everyone in the markets.
We're talking about support and resistance levels. You see, when the price turns around at the same spot over and over again, it creates this really powerful psychological effect. It starts to look like a solid floor, or a ceiling that the market just can't break through. And this impression leads to a very predictable set of actions. First, you spot one of these clear levels. Then you place a trade, betting that level is going to hold again. And then, and this is the critical part, you set a protective stop-loss order right on the other side of that barrier, just in case. Now imagine thousands of traders all doing the exact same thing. All those stop-loss orders, they start to pile up in one very predictable spot. This dense cluster of orders creates a huge pool of what's called liquidity. And you can think of that liquidity as fuel. It's the very fuel that large institutions need to make their big moves.
And here's the thing, that visible pool of liquidity, it's not there by accident. It is a target, and it's the key to a very calculated maneuver designed specifically to take advantage of it.
This maneuver has a name. It's called a liquidity sweep. Essentially, it's a quick, sharp price move that's engineered for one purpose: to punch through that obvious level, trigger all those clustered stop losses, and absorb all of that available liquidity.
The whole process unfolds in 5 pretty clear stages. First, a really obvious level forms and it gets a lot of attention. Second, all those predictable stop-loss orders start to build up right on the other side of it. Third, institutional algorithms lock onto this pool of orders as a target. Fourth, the price is deliberately shoved just past that level, triggering all the stops. And finally, once that liquidity is secured, the market is now free to make its real move, leaving everyone who followed the textbook rules in the dust.
Now, it's important to understand this isn't just a theory. This is a documented, observable pattern that happens again and again across all global markets. Let's look at 2 specific examples.
Our first case study is going to look at one of the most traded currency pairs in the world, the euro versus the US dollar.
So if you look at the chart, the 1.1000 price level had become a really strong resistance. It had pushed back the price 3 different times. So conventional thinking said, this is a safe place to sell. And as a result, a huge pool of stop-loss orders from all those sellers collected right above that 1.1000 mark. It became the perfect target. And then the trap was sprung with absolute precision. The price shot up briefly to 1.1020, just high enough to trigger that huge cluster of stop losses. As soon as that liquidity was absorbed, the big institutional players had the volume they needed to execute their own sales. And what happened next? The price immediately collapsed, all the way down to 1.0950. That breakout everyone saw, it was pure fiction.
And look, this pattern isn't just something you see in one currency pair. Let's take a look at our second case study, this time with the British pound versus the US dollar.
We see a very similar setup here, this time at the 1.2750 resistance level. Again, it looked totally secure. It encouraged a lot of sellers to put their stops just above it. Then came the sudden price spike, up to 1.2775. It cleared out all of those stops, sweeping that liquidity right out of the market. And right after that, the price reversed and plummeted 150 pips. A huge move, and it was powered by the very orders it had just wiped out.
So what these examples really show us is that there's a different kind of logic at play here. The market isn't just moving around randomly, it's on a calculated search for fuel. Okay, so let's compare the 2 ways of seeing the market. The conventional view says the market just bounces randomly between support and resistance. In that world, these obvious levels are points of safety, but the institutional view is completely different.
It sees the market moving with a clear purpose, from one pool of liquidity to the next. And in that reality, those obvious levels aren't safe havens at all. They're destinations.
This forces us to completely reassess how we think about market dynamics. As the source material puts it so well, the market isn't random. It moves with precision.
So here's the key takeaway. Big, significant price moves are almost always preceded by a hunt. The market doesn't just go in a straight line from point A to point B. No, it first makes a detour. It goes to where the fuel, the liquidity, is located. It absorbs it, and only then does it begin its real, intended move.
Once you see this, it really changes everything. It suggests that the most obvious points on a chart aren't barriers, they're magnets. And that leaves us with a final, important question to think about. If price isn't just looking for direction, but it's also constantly hunting for fuel, how does that completely change the map of the market as we know it?